Well, here we go again. It's summer, which for the last 3 years means we talk about a potential summer slowdown in the U.S. economy. This is the second quarter 2012 economic update, and my name is Jeff Hyback. I'm the Senior Portfolio Manager for Strategic Equity Management. But before we get into the economic details, let's get the legal stuff out of the way. Strategic Equity is a registered investment advisor. We are registered with the SEC. And you can get our Form ADV Part 2 from us on our website. You can also go to www.sec.gov. If I do talk about any performance, it's important for you to understand that past performance is not a guarantee of future results, that all investments, including those managed by Strategic Equity, do involve risk. We encourage everybody to speak with their own investment advisor before considering any investments, including those with Strategic Equity. So let's look at what's going on with the economy. As you know, if you listen to any of our past economic updates, we tried to lay out what 2012 could look like. And I'm not going to go into details on each of those. You can get the past updates on our website where we do talk in greater detail about each of these items on here. But this is when I brought out my crystal ball and I kind of looked at what could make it a good year for 2012 and what could make it a tough year? Well, the year started out pretty strong as the economic recovery picked up steam. We got an extension of the payroll tax cuts and then unemployment benefits. We saw a strong earnings season both in the first quarter in January and then again as the second quarter started with earnings in April. We saw a little bit of a solution in Europe. They call it the long-term refinancing operation. The Federal Reserve continued their easy money policies. And so the year started out great. And then it sort of started to waver. In fact, the first 2 months of the second quarter were some very down months. And it looked like a lot of the things that could make it a tough year were coming to fruition. But now as I take a step back and kind of look at this list and see what the market's looking at, what I'm finding is that we have a whole lot of question marks again, where everything seemed pretty clear back in January when we did this update. I'm seeing that the recovery's kind of wavering a little bit. We'll talk about that in a minute. We don't know what's going to happen in Congress. It seems like every day there's somebody talking about what they're going to do with tax cuts or what they're not going to do with it. The earnings growth, earnings season has just gotten underway, and that kind of seems to be questionable. The European leaders, we don't know what they're going to do. They keep trying to go back to that well and say we're going to bail out this failed country or these failed banks, but the problem is they don't know where the money's going to come from. And so anything until they get some real structural changes over in Europe, all these solutions are nothing more than band-aids. You also have to question whether it is too late to save many of the European countries and the banks. Starting with Spain, and we here, you go back down to Greece, which we've talked about the last 2 summers, and they're wanting different terms on their bailout. So it's just a big question mark there. And then of course throughout the rest of this year, we're going to hear a lot about the stimulus from Congress going away, both in the what they call the sequestered cuts from the mandatory spending, as well as the tax cuts. Everybody's calling that the fiscal cliff, and that's something the market's going to be handling, as well as this ugly election year rhetoric. On this list, though, I have crossed out a couple things that I think don't come into play anymore. They've worked themselves out. I think the expectations that were overly optimistic to start the year have really been reined in. You still hear a few analysts talking about 1,500 for the S&P by the end of the year, but for the most part, most professional investors and advisors have gotten a little bit more bearish, which takes that off of the negative part of the list. As I always say, when everybody's bearish, I want to be bullish, and vice versa. Well, the beginning of the year, we were seeing a lot of people were moving towards that bullish camp, but as the summer has started, they've kind of retreated back to the sidelines. And then also, easy money causes runaway inflation. I don't see that money that the Fed has been printing taking hold in the economy. And in fact, We're seeing it in China right now. We saw it in the manufacturing prices paid index. We've seen it in the PPI and CPI. We're going back towards that 2008, 2009 problem where the Fed's going to start focusing more on deflation rather than inflation. And the reason deflation is so bad, a lot of people think, well, it's good that prices are going down. It makes things cheaper. Well, what it does is it discourages people from spending money, because if they see prices going down month after month, they're going to just continue to hold on to their money waiting for a better price. So 2012, the second half is not as crystal clear as it was during the first half. But let's take a look at my leading economic recovery indicators, and these are things that we've been tracking for you guys over the last several years. There's some of the things that helped us call the recession back in 2007, as well as call the end of the recession back in 2009, and more importantly, last fall when we said, no, we're not going back into a recession. Now, one thing that you will notice if you have watched our last two economic updates is the recovery is slowing down. Some of the things that were growing strongly have decelerated. Some of the things that we need to see growing faster to see a strong recovery or even an average recovery have slowed down. So let's look at a couple of those indicators in more detail. The number one performing indicator continues to be the housing market. And again, it's coming off of some very severe levels, and that's encouraging. I'm not saying we've seen a bottom in housing prices. I'm not even saying that this indicator won't dip again. But what I'm focused on is the year-over-year change and the addition this is having to our economic output. If you look, we're growing at nearly a 30% rate versus a year ago as far as building permits go. And remember, whenever a new house is being built, you have tons of economic activity surrounding that output. So that creates jobs, it creates spending on materials, it creates spending when a person moves into that new home. So that's an indicator that we're going to continue to watch closely, because it can drag the economy along. One thing that made me optimistic over the last couple quarters is the fact that we've sort of worked our way through the bubble. Now, that's not to say that this trend line, the blue line here on the chart, can't go below the long-term average as far as building permits goes, but we've finally gotten rid of the bubble that you can see back in the 2000s. And what's important to understand is the correlation that housing activity has to economic growth. This is by far my favorite chart. If you look at the red line, that's the GDP, that's our economy. And you look at the blue line, and you can kind of see how the blue line tends to drag the direction of the economy. And one thing that I will be curious to watch over the next couple quarters is whether or not the continued strength in housing will once again turn the economy up, or whether the slowdown we're seeing that we're going to talk about in just a minute will start to hit the housing market. It's going to sort of be housing versus manufacturing as we move forward the second half of the year, and we'll see which one has the strength to win. One thing that is kind of leaving me questioning the ability for housing to continue its uptrend is the slowdown we've seen the last 3 months in the number of jobs created. You could see we had a nice boost going into the end of 2011 and the beginning of 2012, but since that time it's slowed down. Now, again, this could just be a summer slowdown where maybe we borrowed some of the activity from the prior months, which means we had a slower summer, or it could be something bigger. That's something we really need to watch. One thing that is for certain is if we keep this trend up, it's going to be a very, very long recovery. You could see if we continue at the current 3-month average gains, which is less than 70,000 jobs per month, it would take us all the way till the spring of 2017 to recover all of those jobs that we lost. Now, this doesn't count people coming back into the workforce, new people entering from college. This is just to replace the number of jobs worked. We all know that our population continues to grow, so our unemployment rate could remain stubbornly high unless we find something in our economy that'll generate more jobs growth. But the biggest thing I'm concerned about is the slowdown we saw in June in manufacturing. My favorite indicator as far as predicting both a recovery and a recession is the new orders index that's part of the manufacturing survey. And you could see that drop that we had in June is almost a straight down drop. And it's the biggest one we've seen since we go all the way back to 9/11 and the months following that. So this 1 month change in the new orders component tells us that there's something that happened in June in manufacturing. And you can also see this up in the order backlog. You could see another big drop there in the backlog of orders, which means there's not much in the pipeline to give us hope over the coming months that we're going to see new orders pick back up. So this is something, again, we're going to see a tug of war. Is it going to be, housing? Is that going to be able to create enough jobs and get more activity going to pull manufacturing along? Or is this weakness in manufacturing and the weakness in the number of jobs created going to bring housing back down to a much slower growth rate? And only time will tell. This is the first month we've seen such a big drop in the manufacturing index. So again, going back to what could 2012 bring? You see all the question marks, and honestly, I feel like this is a cop-out, but I don't know. I really do not know which way we're going to see it go. I think, I tend to always focus a little bit on what can go wrong, and that's just sort of a defense mechanism that I have. I think there's just a lot of things that are out there that could really derail it. I think we've been, if you want to use the biblical analogy where, we've built our recovery on the sand, and we haven't built any of our recovery on a rock. And without that, then, as the tide comes in and, you get some problems in Europe, you get some of these banking scandals or whatever it is comes in, and it can just wipe away the whole foundation of the recovery. However, I do think that we could get some surprises. We could get an extension of the tax cuts way before the election. We could see the Federal Reserve finally do something different than what they've been doing all along. We could see a lot of different things come in that could really surprise the market, because again, I crossed out that overly optimistic expectations on the tough year side of the ledger, because I think I've seen people get a little bit too negative. So I want to caution people against thinking, well, it's just going to be awful, I'm going to park money under the mattress, because I do think there's opportunities for everybody to be surprised, and some really strong gains could be pent up in the market. So that leads to the question, well, what should I do with my investments? Why shouldn't I park it under the mattress? Or why shouldn't I just leave it invested in the market? And that's what we do at Strategic Equity. We are active money managers. What that means is we don't believe that you can just sit in a series of mutual funds or a series of stock investments or whatever it might be and just rebalance once in a while and hold on to it. Number one, we've seen psychologically, easy for me to say, that people just can't stomach some of the big losses. But number two, we've seen that buy and hold investing was really promoted during and immediately after what we call now the unraveling period in our social cycle, where everybody was focused on buying more stuff and not so much focused on managing their balance sheet. And now as we get to a time of crisis, which was caused by that focus on accumulating stuff, the 18-year cycles that the market has followed, the demographic cycles, the social cycles, and these economic cycles, means that the good times aren't there yet. We believe they will be there, but we got to work through the tough times. And with active management, we have the ability to try and make money during the good times, but we also have the ability to move to things that will help protect money on the downside. Now, it's not perfect. It definitely will have some losses. But what we've been doing, for instance, if you look at what's happened during the second quarter, is we've been in what we call a transition stage. These are just examples of what some of the stages might be with our investments. And they're going to vary from program to program. But for the most part, we spent the bulk of the second quarter in that transition stage. And we can easily, remember I said we might be surprised by what Washington and the Federal Reserve and the European bankers come up with. We could easily transition to that bullish stage, but we could also just as easily transition to a neutral or a bearish state where we have little to no exposure to the stock market. That's what helped us in 2008. That's what helped us in 2002. In 2000, and some of the other bear markets that we even saw that were very quick ones in the 1990s. Remember, we've been doing this for 20 years, and this isn't the first time we've seen a market like this. Now, I'll argue it's the first time we've seen so much risk in the market, but as far as the stock market goes, it's acting just like it had in past times. So we're not trying to time the market. We're just trying to slide in and out. And right now we're in that transition stage, waiting to see what's going to happen the second half of the year. Either way, we have a foot in the game, and we have a plan to get either more aggressive or more defensive, whatever the situation dictates. If you like what you heard and you want to get more information, I write a daily blog, and I post it on our website. It's www.stratequity.com. You can sign up, either if you're an individual investor, click on that investor button, or if you're an industry professional, you can click on the professional there. And then once you do, you'll get an email from us verifying that you are indeed a real person, not a computer. You come back to our site, you log in, and off to the right will be something that says Trading Desk Updates. And from there you can get my daily insights. We also record some podcasts that are available on our homepage. We'll put the most recent ones right there at the bottom, and we have podcasts listed under the resources. I truly am an optimist. As we close this out, I want to hope for the best, but one thing we always caution people: hope is never a good investing strategy.